High interest rates in advanced economies are affecting the borrowing costs and debt sustainability of emerging and developing economies, especially those with low creditworthiness or fiscal weaknesses. As the U.S. economy recovers from the pandemic, thanks to rapid vaccine rollout and massive fiscal stimulus, its interest rates have risen sharply. This reflects higher growth prospects and inflation expectations, as well as a more hawkish stance by the Federal Reserve. Higher interest rates in the U.S. have spillover effects on the rest of the world, especially on emerging and developing economies that rely on external financing. These countries face a double challenge. They have to cope with a slower recovery from the pandemic, due to limited access to vaccines and fiscal space, and they have to deal with tighter financial conditions, due to higher borrowing costs and lower capital inflows. According to the World Bank, global growth has slowed sharply and the risk of financial stress in emerging and developing economies has intensified amid elevated global interest rates. The Washington-based lender warns that a rapid hike in interest rates leaves the global economy in a precarious position. The impact of higher interest rates in advanced economies on emerging and developing economies depends on the reason behind the rise. The IMF finds that when interest rates go up because of good news about U.S. jobs or vaccines, most emerging markets tend to benefit from stronger portfolio inflows and lower spreads on U.S. dollar-denominated debt. This is because good economic news in advanced economies could boost export growth for emerging markets, and the pickup in activity tends to lift their domestic interest rates as well. However, when interest rates go up because of expectations of more aggressive monetary policy actions by central banks in advanced economies, it can harm emerging markets. The IMF estimates that each percentage point rise in U.S. interest rates due to a monetary policy surprise tends to lift long-term interest rates by 1/3 of a percentage point in the average emerging market, or 2/3 of a percentage point in one with a lower credit rating. Higher interest rates in advanced economies increase the debt burden and the risk of default for emerging and developing economies that have accumulated large amounts of public and private debt during the pandemic. According to the IMF, global debt rose by 28 percentage points to 256% of GDP in 2020, reaching a record $226 trillion. Public debt now accounts for almost 40% of total global debt, the highest share since the mid-1960s. While advanced economies and China accounted for more than 90% of the debt surge in 2020, most developing economies face limited access to funding and often higher borrowing rates. These countries are more vulnerable to sudden shifts in investor sentiment and capital outflows, especially if they have low creditworthiness or fiscal weaknesses. The IMF warns that high debt levels could pose significant challenges for policymakers as they try to strike the right balance between supporting the recovery and ensuring debt sustainability. The World Bank urges emerging and developing economies to strengthen their fiscal frameworks, improve debt transparency and management, and foster domestic capital markets. High interest rates in advanced economies are slowing down the world's major economies by increasing the borrowing costs and debt sustainability challenges for emerging and developing economies. These countries need more support from the international community to overcome the pandemic and its economic consequences. The world economy has been hit hard by the pandemic and the war in Ukraine. These events have disrupted global trade and economic activity, especially for developing countries. The pandemic affected services trade more than goods trade. Services trade fell by more than 20% in 2020, almost 4 times the decline in goods trade. COVID restrictions curtailed the service sector, while goods trade recovered fast as factory shutdowns were limited and there was a surge in demand for some durable goods. The war in Ukraine has rocked the global economy, as quick-fire Western sanctions isolated Russia, collapsed its currency and financial assets and sent energy and food prices soaring. Russia's $1.5 trillion economy is the world's 11th biggest, but it faces a 30-year economic setback as a result of its invasion. The sanctions have made Russia's biggest banks radioactive, traders are shunning barrels of Urals crude oil, and Western companies are fleeing the country or shutting up shop. Russian stocks have been kicked out of global indexes, and trade in some Russian companies has been halted in New York and London. The conflict has also had a significant impact on shipping costs, which have increased by around 350% since May. Imbalances in regional trade brought about by the pandemic and the war have contributed to the rise in shipping costs. The impact of the COVID shock and the war on trade was different across countries. In particular, the fall in Chinese trade was much smaller than in other regions. The recovery of Chinese trade was especially strong, supported by robust global demand for goods and China's ability to reopen its domestic supply chains ahead of other countries. On the other hand, developing countries have suffered more from the slowdown in global trade and economic activity. Africa and Latin America and the Caribbean are projected to see significantly lower growth, compared to pre-pandemic projections, leading to more poverty and less progress on sustainable development and climate action. The number of people living in extreme poverty is projected to remain well above pre-pandemic levels, with poverty projected to increase further in the most vulnerable economies. In Africa, the absolute number of people living in poverty is projected to rise through the war in Ukraine has also resulted in significant loss of human capital, destruction of agricultural trading infrastructure, huge damages to productive capacity, including through the loss of electricity, and a reduction in private consumption of more than a third relative to pre-war levels. These factors have lowered the growth prospects and income levels of many developing economies, especially low-income countries, and increased poverty and inequality. The world economy needs a coordinated, sustained global approach to containing COVID-19 that includes universal access to vaccines, and a peaceful resolution of the conflict in Ukraine that respects its sovereignty and territorial integrity.